You buy your first crypto just to try it out. A small amount, nothing serious. And a few weeks later, your account shows $1,000 in profit. Not from salary, not from overtime, from clicking a few buttons. And that's when the real game starts. Hi, I'm David, and today we're not talking about how to make your first $1,000 in crypto. We're talking about what happens after. Because the first thousand doesn't build you, it tests you. Let's reset the narrative. Most people think the first $1,000 proves they're smart. It doesn't. It proves they were exposed to volatility. Crypto is one of the few markets where beginners can experience extreme gains before they experience discipline. That is dangerous, because your brain doesn't register randomness. It registers validation. You didn't just make money, you felt right. And feeling right is addictive. Now, here's the psychological shift nobody warns you about. After your first $1,000, your risk tolerance quietly expands. If $1,000 was possible, $10,000 feels logical. If one trade worked, why not double the position next time? This is where compounding works against you. Not financial compounding, emotional compounding. Confidence compounds. Position size compounds, exposure compounds, and so does downside. Let's talk math instead of dopamine. If you turned $3,000 into $4,000, that's a 33% gain. But if you lose 33% after that, you're not back at $3,000. You're at $2,680. Losses compound differently than wins. Crypto volatility amplifies that asymmetry. Now, zoom out to today's environment. Bitcoin is no longer a fringe experiment. Ethereum isn't an underground project. Institutions are here. ETFs exist. Liquidity cycles are faster. But volatility hasn't disappeared. It has matured. Retail still enters late. Retail still exits emotionally. And the market still transfers capital from the impatient to the structured. After your first $1,000, you face three paths. Path 1. Escalation. You increase position size. You start checking charts hourly. You feel like you understand the cycle. This path often ends in a 40 to 60% drawdown that erases months of gains in weeks. Path 2. Paralysis. You become afraid to lose the $1,000. You sell too early. You hesitate. You convert volatility into small wins and missed upside. Path 3. Structure. You treat the $1,000 not as profit, but as proof of concept. Proof that markets move. Proof that you can participate, not proof that you are special. Now let's discuss scale. The biggest mistake after the first $1,000 is lifestyle inflation of expectations. You start mentally spending unrealized gains. You calculate what $50,000 would look like. You imagine quitting something. You imagine freedom. But markets punish projections without capital depth. Because here's the uncomfortable truth. A $1,000 gain on a small account often came from high relative exposure. Maybe you put 60 to 80% of your capital in one asset. That strategy does not scale safely. Turning $5,000 into $6,000 is exciting. Turning $100,000 into $120,000 requires a different psychology. Liquidity changes behavior. Fear changes behavior. Slippage changes behavior. Now let's talk about the 2026 reality. Crypto cycles are compressing. Information spreads instantly. Narratives peak faster. Meme coins move violently. AI tokens surge. Layer 2 projects rotate. Liquidity migrates quickly. What worked in 2021 does not work identically now. After your first $1,000, you are no longer a tourist. You are exposed, and exposure requires rules. Rule 1. Position sizing. No single trade should emotionally destabilize you. If a 20% drop ruins your week, your position is too large. Rule 2. Liquidity awareness. Small cap tokens can rise 200%. They can also drop 80% with no exit liquidity. Paper profits are not realized gains. Rule 3. Tax reality. That $1,000 gain may be taxable. Short-term gains can reduce your actual net outcome significantly. Many first-time winners forget the government participates too. Rule 4. Opportunity cost. If your entire mental bandwidth is consumed by charts, what is happening to your career? Skill compounds more predictably than speculation. Let's talk identity risk. After your first win, you might start identifying as a crypto person. Identity increases bias. You defend assets emotionally. You ignore contradictory information. You average down not from logic but ego. Markets do not reward identity attachment. They reward adaptability. Here's another layer. Volatility feels productive. Price movement gives the illusion of progress. But wealth building is often boring. Diversification is boring. Rebalancing is boring. Taking partial profits is boring. Boring survives cycles. Now let's do clean numbers. If you consistently extract $1,000 gains 4 times a year, that's $4,000. Invested systematically over 10 years at moderate returns, that becomes meaningful.
But if you chase one $20,000 breakout and lose $12,000 trying, your volatility erased your discipline. After the first $1,000, the question shifts. It's no longer, how much can I make? It becomes, how long can I stay in the game? Longevity beats intensity. Crypto rewards survivors. Every cycle creates new winners and erases over-leveraged ones. Leverage is the silent destroyer. It magnifies both skill and illusion, and most beginners cannot distinguish between the two. So what actually begins after the first $1,000? Temptation, ego expansion, narrative attachment, cycle exposure. But also awareness, education, strategic allocation, capital discipline. The first 1,000 is noise. The second 1,000 tests consistency. The fifth 1,000 tests restraint. The 10th 1,000 tests humility. And the first major drawdown tests whether you learned anything at all. Here's the final filter. If you cannot define maximum position size, exit criteria, risk tolerance percentage, time horizon, allocation to non-crypto assets, you are not investing. You are participating in volatility, and volatility is not a strategy. Crypto is not inherently reckless, but unmanaged exposure is. The market does not care that you believe. It does not care that you were early. It does not care that you deserve the upside. It only transfers capital according to structure. So when you make your first $1,000 in crypto, don't celebrate too loudly. Pause. Zoom out. Ask, was this process repeatable? Was this risk measured? Was this capital protected? Because the real goal is not your first 1,000. It's controlled growth without catastrophic regression. The first $1,000 feels like arrival. In reality, it's the beginning of psychological pressure. And if you handle that pressure correctly, you might actually build something durable. If you don't, the market will educate you expensively.